Hello, Stephen Cruz here with Paragon Mortgages and mymortgagebroker.com. And today I wanted to talk a little bit about whether you should refinance your home or not. And so I have a client that talked to me last week, and I wanted to go through his situation and then work through the calculations and show you how you can calculate that, and then decide if it's better to do that or not. So let me just share my screen so that we can move forward. Okay, so here's my website, and there's a page on my website that I use to help calculate whether or not it's worthwhile to refinance your house. So to find that page, you can go to my homepage, mymortgagebroker.com, and click on calculators in the middle. And then down here, the third article is why should you refinance your home? And that article has a calculator here to help you figure out whether or not it's worthwhile. So this is what I use with many clients to see where they are and then to help them decide. And then we do use some other factors, but you can do this yourself using this calculator. And I will put the calculator in the link below. So before I keep going, I should remind you, if you enjoy the information I provide here on this channel, please subscribe below and press the like if you think information is awesome. If you have any questions about your own situation or questions about what I've done here, then please put comments in below and I will answer your comments and help you out. If you wanted your more specific details, it's probably better to connect with me directly rather than putting your information on the screen there. So I have a client last week we met, and he had a mortgage of $295,000. So let's put that in here. $295,000 is what his mortgage balance was. His interest rate was at 2.99%. So let's just scroll down and move this to 2.99%, or 98, I guess. I can't get it there. 3%, close enough. So 3%, and usually what I recommend people do is they see if they can recover their cost for doing a refinance over the next 18 to 24 months. So let's just put 24 months here to make sure that works out. And we'll look at a 25-year amortization. They had a slightly shorter amortization, but let's just use 25 for ease of calculations here. So if he was going to refinance his house, he actually couldn't get a ton of money out of his house. His home was worth $395,000, $400,000. So if it's worth $400,000, the maximum we can finance is $320,000. So let's put $320,000 there. And a part of the refinancing is going to cost him some money. So the cost of refinancing, he's going to pay a penalty to pay out the mortgage. So there's a penalty, and he told me this penalty was $3,500, and then he's going to pay legal fees, and the legal fees are going to be around $1,000. Plus, there's going to be appraisal, $3,500 plus $1,000 plus probably $350 for a appraisal fee. So it'll be $4,850, let's say, in total costs to set this all up. Now he's going to get some extra money out to pay off debt, and so the maximum we can do is $320,000. But what I want to do is compare apples to apples and see, first of all, if we can recover his costs. So I'm going to keep the $295 here, and so we're comparing $295 to on both sides plus the cost, and the new interest rate is going to be a little lower than what he's paying right now. But not a lot lower, so a little bit lower, and 2.74, and we'll keep it at 24 months so we compare apples to apples, and then we'll use 25 years for now. So let's look at the calculations. 295 versus 299,000. 13 payment is 1396 versus 1379. So there's a difference in payment of about $16. And at the end of the term, so at the end of 24 months, so that's not the term he chooses, but that's what's left on his mortgage. 24 months is 298. So only there's a couple of $1,000 actually. So he's not. So the end of 24 months, he's not really saving that much money. If we try to keep the payments the same, there's close $2. So they're within $2 of one another, almost $3. And so over 24 months, that's $70 difference in payments, so it's not a lot. You can see that it costs him still $3,000 to refinance his mortgage, pay the legal, pay the penalty, and pay the appraisal cost. And so in this case, it's probably not worth it for him if he was just to refinance and include the penalty into the financing. Now, this client wanted to refinance and get some money out to pay off debt, and so we would actually give him $320,000, which could ease his cash flow, which would help him to pay things off. But what I have is another calculator that I use, and let me show you this calculator as well. And so with this calculator, we can look at his debt. He's got about $14,000 owing on a TD Emerald Visa, and the interest rate's at almost 10%. He pays $200 a month. He's got a TD Visa with $5,000 owing. That's at a higher interest rate, and he only pays $100 on that one. He has an RSP loan that has $1,400 left and $400 a month owing, which is quite a bit. And then he's got a student loan, and then he's got his mortgage. So if he was to refinance and we got him $320,000, that would give him about $20,000, because they're almost $5,000 in costs. So we'd get about $20,000, which would be enough to pay off this debt. That we would still leave the student loan. So it would ease his cash flow if he was to do that. But I'm still not convinced it's a good idea for him to do it. And that's what we talked about. So if we were to put all of this debt into his calculator, he can afford to pay $3,250 every single month towards his debt. And that's what he's been doing. I put the minimum payments in here so you can see what his minimum payments are. And so he's putting about $200, just under $200 a month extra towards the debt, and he's just not seeing it go anywhere. And really the reason is because of this big RSP loan that he took out before. And so what I suggested he do is, rather than apply the extra money towards one of these, which it was his visa, this visa he was paying off, rather than doing that, it's just attack the smallest debt. And so do the snowball balance effect. And so this is what the snowball balance looks like. He takes that extra $200 and he applies it to the RSP loan first. And there's a little payment schedule in this second tab that shows. So he's putting $650 against his RSP loan every month, and that's paying that off so much faster. And then he can start applying, after 3 months, basically, he can start applying all of this money towards the TD Visa. Now that's the higher interest rate, smaller balance visa. And now he's paying almost $700 from April of this coming year. Now he's going to get a tax refund, and he talked about that. And so he's probably getting a refund around $3,000 or $4,000. And so the refund itself he can use to apply here. I didn't put this in the calculations because he hasn't got the money yet, but he can apply that, and then it'll just push his months away. So it'll take him altogether 10 months to pay off the TD Visa, and then he can take all of that money and roll it onto his other visa, the Emerald Visa, that has a higher balance. And so that, again, will be another few months. December in 2021, he'll have that paid off, assuming he doesn't take any of this other some RSP money or tax refund he's getting, etc. So assuming that he does that, now he's going to have his debt paid off quite a bit faster. With this strategy and paying off this debt the way it is, I don't think it's worth it for him to refinance his mortgage right now. And he's paying out extra money to get rid of some debt, but it's not saving him a ton of interest to do it. And so when we analyzed it, it was better not to. So what I've done is I actually I wrote an article, and it's called "Why Should You Refinance Your Home Mortgage?" And I talk about why you might want to and why you won't, why you don't want to, and why you should take a look at the costs, because the costs are really important. And if you can recover your costs within 18 to 24 months, then it could be worthwhile to do it. If you are strategic, and then if we help you with a cash flow plan, it may actually be cheaper not to, and do what this client does. And And so he's just going to put the money against the debt that he has to accomplish that goal of paying off the debt. And when his mortgage comes up for renewal in about 3 years from now, then we can evaluate whether or not he's in a better position, or whether or not he should just move it to another bank or get a better rate or whatever. So we can do some other checks and balances with him in the future. But this article talks a little bit about the reasons, talks about the fees, so you understand how the fees work and what you should do in relation to that. And then we just go through some of the details about why you should do that. And then this calculator is again here as well. So I really believe that it's important for you to decide why and make sure you play with the numbers, because a lot of times your bank or a broker or whatever will encourage you to consolidate your debt, but it's not necessarily the best plan. And so make sure you check your fees and costs before you do that. So thanks again. If you enjoyed this video, if you thought it was good, valuable information, please subscribe and like the channel, and then we can send you more videos as we create them. Thank you, and have a great day.